CVS Health is crashing down to a new 52-week low. This now gives it a forward yield of around 5%, and just year to date it is down 32%. So is this an undervalued company now that we need to consider for our portfolios, not just for the dividend but also long-term growth? We're also going to touch upon their dividend safety score. Now it is at 80, however it just was recently downgraded from very safe to safe, so we need to understand any potential concerns with this moving forwards. We'll also touch upon some insider movement. We have noted some insider buying just over the last few weeks. And we'll also talk about the institutions, whether or not they continue to add this company to their overall portfolios. As always, not only will we look at this company in terms of their growth with their new numbers from their latest quarterly report, but we'll see their top line revenue as well as their bottom line net income, try to identify any issues, any inconsistencies, and as always, we are going to look at the health of this company, their total cash versus their total debt, and we now have their latest quarterly numbers to update ourselves and see if there are any new things to note. As always, we will take a quick look for those that did miss their latest investor presentation. Just a few key things to touch upon, and in terms of their earnings, if you did miss out on that, we will do a very quick high-level update review. As always, and very importantly, we want to revisit what is the intrinsic value of CVS Health, what is our acceptable buy price given our investor margin of safety, and see what do Wall Street consider as the implied upside over the next 12 months. So first thing that we'll do, especially for those that have missed their latest earnings, we'll take a very quick look. Now we can see just off their earnings at the beginning of May, the share prices did plummet. Since then, they are down another 10%. One of the reasons for this is in fact they did lower their full year profit outlook, and as we can see, higher medical costs are causing an issue, not just for CVS but also the broader US insurance industry. We are seeing a lot of companies that are significantly down. We just touched upon United Health Group yesterday, but Humana as well as others are also having issues in this industry. Now, one thing we just want to very quickly point out, in terms of their earnings, they did miss quite terribly if we're completely honest. Earnings per share was $1.31. The market did expect a lot higher. In terms of their revenue as well, they did miss as well, $88.4 billion. 89.2 was expected. Now we'll take a look at this in more detail as well as their outlook, but they did lower their forward guidance, which also really hurt this company. And when we take a look year to date, very poor, down 32%. Over the last 12 months, slightly better but still very poor, negative 20%. And if you've been a long-term shareholder, you probably would have not experienced anything but real pain, down negative 31%. Do bear in mind, if you do reinvest those dividends, it would be marginally higher. And if we do take a look at their more recent highs, January 2022, this was trading pretty much double the current trading price, $108. Now we do note a buy rating from Wall Street, however a double hold from the other two analysts, and we can see on a forward P it is very low, 7.63. So let's find out whether or not this is warranted, or in fact this is a golden buying opportunity. Now we do want to very briefly just cover their top line growth. Now whilst we may want to see 3 to 7% growth year on year, we actually note that their top line has increased quite considerably, around $139 billion, more than doubled into the latest annual report at $356 billion. And we can see pretty consistently over the longer term, they have been increasing their top line, which is always a positive sign. But as always, we do also need to anticipate the forward guidance and bring that into our analysis. Now, in terms of the bottom line, we do note it has doubled pretty much as well, $4.6 billion. But when we look at it on a graphical basis, we do note a fair amount of inconsistencies, a net loss in 2018, a drop into 2022 as well. And we can see very, very inconsistent year on year. In fact, we note going from 8 billion down to 4, back to 8.3 in the more recent period. So overall top line has been okay, bottom line though a lot more inconsistent. And now we do have the updated numbers. We can see from their balance sheet it's gone from 2.5 billion in terms of cash and their short-term investments to over 13 billion. So over the longer term they have been building up quite a considerable cash position. But on its own, this number doesn't really tell us anything. We do need to compare it to their total debt number. What we do identify when looking at this is that it has increased very rapidly, 12.9 billion in 2014 to around 82 billion in that latest quarterly report from May. And as we can see, that is a bit of a red flag indicator. They do sit on a very large debt position, something we do ultimately need to cover when we do discuss their dividend safety and some underlying metrics later on in the episode. Now, in terms of the earnings, just a very quick note to say that their historical performance has a track record of 3 beats out of the last 4, so 75%, but they did miss quite considerably in the more recent quarter, negative 0.39 cent miss. Forward looking, they do anticipate for the next 3 quarters to be a negative growth year on year on the earnings per share until quarter 1 of 2025, where they see some strong double-digit growth. Now again, just something to factor in, especially when we do incorporate our margin of safety later on. And in terms of their earnings per share estimates over the next 2 years, if you are looking at this from December 2025, if they do hit those earnings per share, 6.65 or 6.65 I should say, would be that forward PE. Pretty low, but again, this doesn't really mean anything. You also need to look at other parts of this company. Just something, though, that we did want to highlight. Now, in terms of the valuation grade, this is looking at the valuation and the underlying metrics. Overall, an A+, pretty much A across the board. We will just have a look at one of the ones we want to see in particular, the PE on a non-GAAP forward basis. 7.63, basically with the sector median at over 19, you are getting a discount of around 61%, but again, you could argue the basket of companies in the sector are of a higher quality. Whether or not you agree with that, just something that you do need to consider. And when we look at the other metrics as well, A+, they are trading at a very large discount. Price to free cash flow 6.16, a lot better than the 15.36 of others in the industry. So this could be one that there could be some very strong value out there to consider with a nice starting forward yield. We then move on to CVS's growth grade. Now they do get a D-. When we do take a look, 9% increase to their top line year on year. Sector median around 6.9%. Forward looking, however, it does come a little bit lower, 6.3 versus 8.8. And one of the things that I want to draw your attention to for CVS in particular, their earnings per share over the longer term is anticipated to increase 4% year on year, whereas others in the industry are around 11.12. So actually very poor, around 64% worse off. So something just to consider. Other metrics as well if you do want to incorporate that into your own analysis. Profitability grade then an A+, so that is quite nice to note. Although on a trailing 12-month basis, their gross profit margin was very low, 14.6, with other in the sector of 57. In terms of the bottom line net income, 2%, which actually whilst in isolation may look very low, others in the sector will actually perform very poorly in 2023, negative 4%, so the majority did turn a loss, so something just to consider. And with CVS Health, they do have a large amount of cash from their operations, 10.9 billion, whilst others in the sector, in fact, negative 16.63. So a lot of things to consider for CVS Health. Just in summary of this part of our analysis, a buy from Wall Street, a double hold from the other two, A+ on valuation, D- on growth, and A+ on profitability. We then have a very quick look at how they've performed against others in the sector, Cigna Group, as well as a few others that we have considered on the channel throughout the weeks. In terms of total return then, including dividends reinvested, no surprises, very poor, negative 17%, one of the, or if not the worst performing. When we expand that over the last 5 years, not the worst performing, but still not the greatest, 18%. That doesn't even keep up in line with inflation over a 5-year period. Over the last 10 years, again, one of the worst performing, negative 12%. Key to understand from this analysis, yes, historically, very poor return on any of your investments, but remember, past performance is not an indicator here of how they'll perform in the future. Now, insider ownership does sit at 0.24%, and what we do note is one instance of insider buying, as we can see 194,000, whereas we see 2 instances of insider selling of around 4.2 million. Now in the latest quarter, as we can see here, quarter 2 in fact, 54,000 worth of buys at 0 sales, although you only have to go back to the previous quarter to see around 2.27 million worth of sales by insiders. Now, who are these insiders and how much have they been selling? Well, in fact, we can see in the more recent quarter, the directors 2nd of May did buy around 1,000 shares at the price around $54. And as we can see, a very trivial amount. Probably not something to consider in your investment thesis. Typically, if we see larger buys, we do consider a bullish signal. And then you only have to go back to February where the EVP sold quite a significant number of shares at quite a larger price than we see today of around 2.3 million. Whether or not you do include, the information is there. In terms of institutional ownership, well, 81%, 9 billion worth of buys over the last 12 months. Not too far off a similar amount of sales over the same period, but what we do notice is double the amount of buys in quarter 1 than sells, and the same can be said for quarter 4. However, the 2 previous quarters, we do see the opposite true. So yes, over the last 12 months, lots more buying, or in fact marginal amounts of buying I should say, and also in the more recent quarter we see that same trend. Remember, always do your own due diligence, so just something we wanted to point. Now before we do jump into their earnings, a few things to note. We just want to say that we have released our latest free weekly article. We run through the best recession-proof stocks based on historical performance. If you want to grab a copy of this or any others, all completely free, do click on the pinned comment below. For example, if you want to see 20 undervalued dividend stocks you need to consider for the portfolio, or maybe the websites and resources we use in our own company and our own analysis, do click on that below. It is completely free and you can read straight away. So in terms of looking at some things that we just want to highlight in their quarter 1 performance, now revenue growth 3.7%. If you're a regular viewer, you do know we want a minimum of 3 to 4% just to keep up in line with inflation. As always, they have in fact returned a lot of shareholder cash to essentially through share dividends as well as through those share buybacks. And the essential forward guidance, we are going to discuss that as that has been lowered. Now, in terms of how they performed against the same quarter in 2023, well, they did marginally beat, as we can see on the total revenues. However, we do notice it is lower in the operating income. We also note on the earnings per share as well as adjusted, it is lower from the same quarter from the previous year. Cash flow from operations is also down. So, not the greatest. The only real thing to positively note here is that their total revenue is up, but all the other metrics and analysis, they are down. And one thing that we do want to point out, very key to understand, their full year guidance has effectively noted that they are anticipating that everything will be lowered from when they looked at the full year just a few months ago. Total revenues down, operating income down, as well as the earnings per share on both a GAAP as well as adjusted GAAP basis. Cash flow from operations as well also down. So the forward guidance is just something to be aware of. Now, dividend safety, a score of 80, it does look to be safe. Market cap 67 billion, large cap company, and a dividend yield near 5%. Now, what we want to point out that it was in fact downgraded just this month. It doesn't mean there's any issues based on this information. It still remains that the dividend cut does look to be unlikely. Now, in terms of the last recession, how they performed, well, they did increase the dividend during the 07-09 crash. They had above average growth, negative 2.5 versus the S&P's negative 12, and they also returned negative 38, beating the S&P's massive drop of negative 55%. Now, dividend growth was actually pretty decent. Their more recent one, 9.9% in December 23, although we do note over the last 5 years, they have just kept up in line with inflation. Over the last 20, at least, it's very strong double-digit growth, 16% to be exact. Although we do note only 2 years of consecutive increases, as we can see, they did maintain that dividend for several years in the more recent period, but they have been paying a dividend for the last 27 without a reduction. Now, those that are new to dividend yield theory, it does state a company is undervalued when the current yield sits above the 5-year average. 4.96 versus 2.89. We have our first line of undervaluation. Another one here with the forward P 7.4 below the 5-year of 9.9. And in fact, a triple undervaluation signal as the healthcare sector P is much higher at 15.7. Just bear in mind though, we don't look at any of these models in isolation and we will conclude towards the end. Now, free cash flow payout below 40% is the preference for consumer retailers when we're specific. 60% is my blanket rule. This personally to me gives me faith that management can offer double-digit increases to the dividend, which obviously we do all love to see. And personally, I do ignore the earnings. It is susceptible to manipulation by management through accounting. And with the free cash flow payout, we can spot potential dividend incoming cuts. Now, the analysis here is it's below 40% consistently over the longer term. 36% as well anticipated into 2024, so that does look to be good so far. Free cash flow per share, as always, consistent increases to free cash flow is what you want to be investing in companies. What we can see, it has increased over the longer term, very inconsistent, continually dropping from the highs of 2021, and that is expected to continue into 2024 down to 749. As we discussed as well, that forward guidance does look to be dropping, and their free cash flow also looks to be lowering as part of that analysis. Sales growth, as we can see, they've actually performed very well. In fact, the last 2 years, strong double-digit growth, and even in terms of the trailing 12-month, 9% does look very healthy, and as we saw earlier, they have been able to increase their revenue very strongly over the longer term. One thing that it does put a bit of a damper on this is that with shares outstanding, we love it when companies return excess cash through those share buybacks. What we note, the net position for CVS Health is share dilution, increasing it from 1.17 to 1.28 in the more recent period. We then move on to the ROIC, a very important metric, as always, does help us understand, give us faith as well that management are able to effectively allocate their capital. My personal metric, minimum 10%. If you want to be industry specific, 17%. We can see since 2017 that drop, it has been around the 7 to 11%. Ideally, I would like it to be at a double digit at a minimum. 8% on a trailing 12 month just makes this a metric to worth analyze over the longer term. We then move on to margins. Now, one thing I don't like about CVS are their margins, both operating and free cash flow. Operating, not only is it below 10%, which is the minimum that we want to see. In fact, for other companies, it's around 16%, so it is already lower, but it has been decreasing 3% on a trailing 12-month basis. So that does give me a little bit of a worry. I do want to see this at a minimum up to that 10% level. Free cash flow margin as well doesn't meet those heights that we want to see of 6% plus. 2% on a trailing 12 months. So definitely incorporate this when you do consider that margin of safety that we're about to come on to. Net debt to EBITDA, the earnings before the interest, tax, depreciation, amortization. Remember, this correlates to balance sheet strength as well as dividend safety. Below 3 for consumer retailers, and these are the numbers of years it would take the company to pay off all of that debt net of cash on hand. And we can see over the long term, it has straddled around that. Some years, like we see 2018, 2019, very high. 2023, just below 3, but we do know that it is expected to increase. So this could be one of the reasons why we do see that downgrade on the dividend safety. Definitely one that I would say to keep an eye on, and that we will also do on this channel as the annual reports and quarter reports come through. So let's jump into the valuation model. As always, if you enjoy the content, value is being provided, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. So we jump into the first valuation model. We have Graham's formula with the earnings per share, long-term growth rate, AAA corporate bond yield to give us an intrinsic value of just under $70 with a massive undervaluation signal. As we can see, market value is much lower, although do remember we're not looking at any one of these models in isolation. We then move on to the multiples valuation model. Now, as we can see here, we have companies in a similar sector and size that we did analyze. Now, this actually isn't one that we are going to use in the final output, but just to show you, the average P multiplied by the EPS of CVS does give an intrinsic value that is significantly higher. Now, this is one that does trade at a much lower P, hence why we do see this massively skewed data. But again, some people could argue that it is due to the undervaluation of CVS rather than the fact that the other companies are a higher quality. We then move on to the dividend discount model where we have the yearly dividends. As we can see here, very mixed, 6% on average over the period. Forward looking, we have been more conservative, around 4%, so at least keeping up in line with inflation. And the intrinsic value we get here is an undervaluation signal, $69 versus $53.60 on the market price. We then move on to the DCF model. Now we have the free cash flow year on year. Average growth at 9%. We've been extremely conservative, 0%, so this incorporates no growth forward looking. With the discount rate, we have the present value of future free cash flows and terminal value. Add together with the cash, subtract total debt, get to the equity value, divide by the shares outstanding, and as we can see here, another third and final intrinsic value, which shows undervaluation. Now, the intrinsic value in today's episode is just the average of these three models, and it does arrive at $71.47. Also, bear in mind you can grab a copy of this valuation model, getting to your own intrinsic value as well as acceptable buy price by clicking on the pinned comment below. As always, margin of safety, we do start off with 10% and we execute on this if we believe it meets our 3 criteria of a wide moat, strong financial metrics, and good forward-looking data. If you believe this for CVS, then it is a buy up to $64, and then we keep going till it's near the current trading price, so we can see what MOS level we are playing with today, and pretty much it is bang on a 25% margin of safety in today's episode, based on the current trading price of $53.60. In terms of Wall Street and their anticipation, over the next 12 months, they see 36% upside. They have a price target of $73, so they do consider this to be a strong buy for the portfolio, as we did mention at the beginning of the episode. Now, as always, do let us know your thoughts in the comments below, whether or not there are any issues with this company. Maybe it's on your watch list, or maybe this is one you have been buying in the more recent periods. One thing I would say, it does have a nice yield around 5% starting, but the one thing that does worry me with CVS is their total debt levels that do continue to increase, and as we can see with the net debt to EBITDA metric going over 3, and in fact been an increasing trend, it does give me a bit of a worry, not just about this dividend safety, but also about the overall security of the company. One thing that I would say with this company though, they have continually managed to increase their top line very strongly year on year, but another worry for me are those margins. They continue to shrink year on year, and that is the opposite of companies you do typically want to invest in or analyze. You want companies to consider for the portfolio that are increasing both their revenue top line as well as their bottom line net income, and as well their margins. So let me know your thoughts in terms of whether or not you enjoyed the video. Smash that like button if you took value from this. If you want to be continually notified of these videos as they drop, subscribe, hit the bell button. Let us know below, and as always, I will see you all on the next one.